Most people think successful investing is about finding the perfect opportunity, the perfect stock, the perfect moment to buy. But the real problem most investors face has nothing to do with buying. It has to do with selling. People sell far too early. They buy an investment with excitement, the market drops a little, fear takes over, and suddenly they abandon the very asset that could have made them wealthy. Months later, the same investment climbs to new highs and they are left wondering what went wrong. This cycle repeats again and again in financial markets. The reason is simple. Human psychology was never designed for investing. Our brains evolved to react quickly to danger, and in markets volatility feels like danger. When prices fall, our instincts push us to escape. Psychologists call this loss aversion. Losses feel far more painful than gains feel rewarding. Because of this, investors often make decisions based on emotion instead of logic. The wealthiest investors approach markets very differently. They do not think like traders. They think like owners. Instead of asking what asset they can flip for a quick profit, they ask what asset they can own for the next 20, 30, or even 50 years. That single shift in thinking changes everything. Real wealth is rarely built by constant buying and selling. It is built by owning powerful assets long enough for compounding to do its work. In today's world, this idea is more important than ever. Inflation quietly erodes the value of money sitting in a bank account. The cost of living continues to rise, and relying only on a salary is rarely enough to build lasting financial security. If money is not invested in productive assets, it slowly loses purchasing power year after year. The goal of investing should therefore be simple: buy assets that grow, generate income, and become more valuable over time. Then hold them long enough for compounding to multiply their value. Throughout history, a few asset categories have consistently created enormous wealth for patient investors. The first one is one of the oldest wealth builders in existence: real estate. Real estate has produced more generational wealth than almost any other asset class. The reason is straightforward. A good property does not just increase in price over time. It also produces income while you own it. When you own a rental property, tenants pay rent every month. That income can help cover expenses such as mortgage payments, taxes, and maintenance while still leaving profit. But something even more powerful is happening in the background. Every mortgage payment slowly reduces the amount of debt attached to the property. As that balance shrinks, your ownership stake grows. Over time, you build equity automatically without needing to sell anything. Another major advantage real estate offers is leverage. Unlike many other investments, you usually do not need the entire purchase price up front. Banks allow investors to control large assets with relatively small down payments. Imagine purchasing a property worth $400,000 with $80,000 down. If that property increases in value by only 5%, the total gain becomes $20,000. That gain represents a large return on the $80,000 actually invested. This is one of the reasons real estate has historically been such a powerful wealth-building tool. Appreciation is only part of the equation. Rental income provides consistent cash flow, and rents often increase over time. In many cases, they rise along with the cost of living, which makes property ownership a strong hedge against inflation. While cash gradually loses value during inflationary periods, property owners often see both their asset value and their rental income increase. Real estate also provides an important psychological advantage. Stocks move every second, and investors constantly watch prices change. Those rapid movements often trigger emotional reactions. But a house does not flash red numbers on your phone every minute. Most property owners do not wake up checking the daily value of their home. Because of this, real estate investors are far less likely to panic sell during temporary downturns. Over long periods, growing populations, expanding cities, and limited land supply naturally push property values higher. That is why many wealthy families treat real estate not as a short-term investment but as a generational asset. Properties are rented, improved, refinanced, and eventually passed down to future generations. The income continues flowing, the property continues appreciating, and the wealth continues compounding. But real estate is only one piece of the long-term wealth puzzle. Another powerful category of assets comes from owning shares in the world's strongest companies. These businesses dominate industries, generate massive profits, and reward investors consistently over time. They are known as blue-chip companies. The third asset that has quietly created enormous wealth for millions of investors is something surprisingly simple: index funds. Many people believe successful investing requires constant research, complicated strategies, and the ability to predict which company will become the next big winner. In reality, some of the most successful investors discovered that trying to beat the market consistently is extremely difficult. Even professional fund managers with large research teams often fail to outperform the overall market over long periods. This is where index funds become powerful. Instead of trying to pick a few winning companies, an index fund simply buys a large group of businesses that represent the entire market. One of the most widely known examples tracks the S&P 500, which includes hundreds of the largest and most influential companies in the United States. When you invest in a fund that follows this index, you automatically own small portions of companies across many industries. Technology companies, healthcare firms, energy producers, financial institutions, and consumer brands all become part of your portfolio at the same time. This diversification dramatically reduces risk compared to buying only a few individual stocks. If one company struggles or even fails, the impact on the overall investment is relatively small because hundreds of other companies continue operating and growing. Over time, the strongest businesses expand while weaker ones are replaced by new innovators entering the index. By holding an index fund, investors are essentially betting on the long-term growth of the entire economy rather than relying on the success of a single company. History has shown that as economies grow, productivity improves, and innovation continues, businesses expand and markets trend upward over long periods. Index funds allow investors to capture this growth in a simple and efficient way. Another powerful advantage is cost. Traditional actively managed funds often charge higher fees because teams of analysts are constantly researching companies and attempting to outperform the market. However, these costs gradually reduce returns over time. Index funds operate very differently. Because they simply track the market instead of trying to beat it, their operating costs are far lower. Even a small difference in annual fees can make a huge impact after decades of compounding. Lower fees allow more of an investor's money to remain invested and continue growing year after year. Index investing also provides an important psychological advantage. Investors no longer need to chase trending stocks or constantly worry about choosing the wrong company. The strategy becomes straightforward: invest consistently, reinvest dividends, and remain patient during market ups and downs. When markets decline, index investors are not holding a single fragile company. They are holding hundreds of businesses that collectively represent the strength of the economy itself. Historically, markets have recovered from downturns and continued growing over long periods. While index funds capture the power of the overall economy, the fourth asset focuses on a technological shift that could shape the next era of global growth: artificial intelligence. Artificial intelligence is no longer just a futuristic concept discussed in research labs. It is already transforming industries around the world. Businesses are using AI systems to analyze massive amounts of data, automate repetitive tasks, optimize logistics, improve medical diagnostics, and develop new products and services. From finance and healthcare to transportation and manufacturing, artificial intelligence is becoming an essential tool for modern businesses. As adoption spreads, productivity increases and organizations become more efficient. Many economists believe this technological shift could add trillions of dollars to global economic output over the coming decades. However, investing directly in small AI startups can be risky because many new companies fail before reaching long-term success. For this reason, many long-term investors focus on companies that provide the infrastructure behind the AI revolution. These businesses build the hardware, computing power, and platforms that make artificial intelligence possible. Semiconductor manufacturers design powerful chips capable of processing enormous volumes of data. Cloud computing companies operate massive data centers that provide the computing power required to run advanced AI systems. Major technology firms are also integrating artificial intelligence into software platforms used by millions of organizations worldwide. Companies such as Nvidia, Microsoft, and Alphabet are investing billions of dollars into AI research, infrastructure, and development. Their technologies power everything from advanced language models to cloud services and automated enterprise tools. By investing in these foundational companies, investors gain exposure to the growth of the entire artificial intelligence ecosystem rather than depending on the success of a single startup. It is similar to selling tools during a gold rush. Instead of hoping one miner finds gold, you supply the equipment that every miner needs. When we step back and look at the bigger picture, a clear pattern appears. Wealth is rarely created by chasing short-term trends or making frequent trades. Instead, it is built by owning productive assets and allowing time to multiply their value. Real estate generates income while appreciating over long periods. Blue-chip companies produce profits and reward investors with dividends. Index funds capture the growth of the entire economy. And artificial intelligence infrastructure represents the technology shaping the future of innovation and productivity. All of these assets share one critical characteristic: compounding. The longer they are held, the more powerful their growth becomes. That is why the most successful investors in history emphasize patience above almost everything else. They understand that the true magic of investing does not happen in days or months. It happens across years and decades. By buying strong assets, holding them through market cycles, and reinvesting the income they produce, investors allow compounding to quietly build wealth in the background until ordinary investments eventually turn into extraordinary financial freedom.